In today's fast-paced financial world, it's easy to get caught up in the hype and excitement. Everyone wants to get rich quick. But true wealth building is a marathon, not a sprint. That's where Benjamin Graham's The Intelligent Investor comes in. This book, written decades ago, is still the go-to guide for anyone serious about investing. It teaches you how to protect and grow your money over the long term. So what exactly is an intelligent investor? This question has intrigued many for decades. The concept of intelligent investing isn't just about making money. It's about making informed decisions that align with your financial goals and risk tolerance. It's about understanding the market, knowing when to buy, when to hold, and when to sell. It's about patience, discipline, and a keen eye for value. Graham says it's all about understanding the difference between investing and speculating. Investing involves a thorough analysis of the asset, considering its intrinsic value, and making a decision based on long-term potential. Speculating, however, is more about making a quick profit, often without a deep understanding of the asset's true value. Investing is like buying a house to live in. When you buy a house, you consider its location, the quality of the construction, the neighborhood, and its potential to appreciate in value over time. You don't buy a house on a whim. You do your homework, inspect the property, and think about how it fits into your long-term plans. You look at its value, its condition, and its potential to provide a roof over your head for years to come. You might even consider the future resale value, the cost of maintenance, and any renovations that might be needed. It's a well-thought-out decision, made with the intention of providing stability and security for you and your family. Speculation, on the other hand, is like betting on a horse race. You pick a horse based on a hunch, a tip from a friend, or a gut feeling. You hope for a quick win, but there's no guarantee. The outcome is uncertain, and the risk is high. You might win big, but you could just as easily lose everything. You're hoping for a quick win, but you're also taking a big risk. The thrill of the gamble can be enticing, but it's not a sustainable strategy for building long-term wealth. Speculation relies heavily on luck and timing, and while it can sometimes pay off, it's not a reliable way to secure your financial future. There's a lot of luck involved. Unlike investing, where research and analysis can guide your decisions, speculation is more about chance. You might get lucky once or twice, but over time the odds are not in your favor. It's a high-stakes game that can lead to significant losses if you're not careful. An intelligent investor focuses on buying undervalued assets and holding them for the long term. They look for opportunities where the market has overlooked or undervalued an asset, and they invest with the expectation that its true value will be recognized over time. This approach requires patience and a long-term perspective. They're not swayed by short-term market swings. Instead, they stay focused on their long-term goals, ignoring the noise and hype that can lead to impulsive decisions. They understand that the market will have ups and downs, but by staying the course and sticking to their strategy, they can achieve their financial objectives over time. Graham introduces us to Mr. Market, an imaginary business partner who's prone to mood swings. One day, he's wildly optimistic, offering to buy your shares at inflated prices. The next day, he's pessimistic, wanting to sell you shares at bargain prices. Imagine Mr. Market as that friend who's always up and down, influencing your decisions. He might tell you to buy a stock because it's the latest craze, even if it's overpriced. Or he might urge you to sell everything in a panic when the market dips. Margin of safety, your financial cushion. In the world of investing, having a financial cushion is crucial. This concept, often referred to as the margin of safety, acts as a buffer against potential losses. Just as an airbag in a car provides protection during an accident, a financial cushion safeguards your investments from unexpected downturns. The intelligent investor doesn't listen to Mr. Market's emotional roller coaster. Instead of reacting to every market fluctuation, they remain calm and composed. They understand that the market's emotions are not a reflection of the true value of their investments. By staying focused and not getting swayed by short-term volatility, they can make more rational and informed decisions. Instead, they focus on buying assets for less than their intrinsic value. This means conducting thorough research and analysis to determine the true worth of an asset. By purchasing investments at a price lower than their intrinsic value, they create a margin of safety. This approach not only minimizes risk, but also maximizes potential returns. This difference between the price you pay and the asset's true worth is your margin of safety. It's the gap that provides a cushion against errors in judgment or unforeseen market events. By ensuring that this margin is substantial, you protect yourself from significant losses and increase your chances of achieving long-term financial success. Think of it as a financial cushion. Just as a physical cushion provides comfort and support, a financial cushion offers security and peace of mind. It allows you to navigate the unpredictable world of investing with greater confidence, knowing that you have a buffer to fall back on if things don't go as planned. Just like you wouldn't buy a car without checking its safety features, you shouldn't invest in a company without considering its margin of safety. Before making any investment, it's essential to evaluate the company's financial health, management team, and competitive position. This due diligence helps you identify potential risks and ensure that the investment aligns with your financial goals. You shouldn't invest in a company without considering its margin of safety. By doing so, you protect yourself from potential losses and increase your chances of achieving long-term financial success. Remember, investing is not about taking unnecessary risks, but about making informed decisions that align with your financial goals. It protects you from losses if things don't go as planned. A well-thought-out margin of safety acts as a safety net, catching you when the market takes an unexpected turn. It ensures that even if your investment doesn't perform as expected, you won't suffer significant financial harm. This protection is invaluable in maintaining your financial stability and achieving your long-term investment objectives. Defensive versus enterprising investors. Different strokes for different folks. In the world of investing, there's no one-size-fits-all approach. Just like in the classic fable of the tortoise and the hare, different strategies work for different people. Some investors prefer a slow and steady approach, while others are more inclined to take risks for potentially higher rewards. Graham understands that not all investors are the same. He recognizes the diversity in investment strategies and the varying levels of risk tolerance among individuals. This is why he categorizes investors into two main groups: defensive and enterprising. Each group has its own unique characteristics and approaches to investing. He divides them into two categories: defensive and enterprising. This division helps investors identify which strategy aligns best with their financial goals, risk tolerance, and time commitment. Understanding these categories can be crucial for making informed investment decisions. Defensive investors, as the name suggests, are more risk-averse. They prefer to avoid the volatility of the stock market and focus on preserving their capital. These investors are often more conservative and prioritize the safety of their investments over high returns. They prioritize safety and stability. Defensive investors typically invest in blue-chip stocks, bonds, and other low-risk securities. Their goal is to achieve steady, long-term growth without exposing themselves to significant market fluctuations. They're like the tortoise in the race, slow and steady. This approach may not yield the highest returns, but it provides a sense of security and peace of mind. Defensive investors are patient and willing to wait for their investments to grow gradually over time. Enterprising investors, on the other hand, are more willing to put in the time and effort to research individual stocks. They are proactive and constantly seeking opportunities to maximize their returns. This group of investors is not afraid to take calculated risks in pursuit of higher profits. They're seeking higher returns and are comfortable with more risk. Enterprising investors often invest in growth stocks, emerging markets, and other high-risk, high-reward opportunities. They are driven by the potential for significant gains and are prepared to handle the ups and downs of the market. They're like the hare, looking for a quicker pace. While this approach can lead to substantial rewards, it also comes with greater risks. Enterprising investors must be vigilant and adaptable, ready to make quick decisions based on market conditions. Ultimately, whether you identify more with the tortoise or the hare, understanding your investment style is key to achieving your financial goals. Graham's principles in today's market. Still relevant? You might be thinking, these principles are all well and good, but does Graham's advice still hold up in today's market? The answer is a resounding yes. While the investment landscape has changed with technology and globalization, the fundamental principles of value investing remain timeless. Think of it like this. The tools we use to build houses have evolved over time, but the basic principles of architecture and structural integrity remain the same. The same goes for investing. Conclusion: timeless wisdom for modern investors. The Intelligent Investor is more than just a financial guide, it's a roadmap to financial freedom. By understanding the difference between investing and speculation, tuning out Mr. Market's noise, and focusing on the margin of safety, you can build a portfolio that weathers market storms and grows steadily over time. Remember, investing is a marathon, not a sprint. Slow and steady wins the race.